Good day, fellow investors. Yesterday we discussed how the emerging market ETF is not that cheap, and in this video I want to discuss the top 10 stocks from the list. I recently looked at the top 100 and we'll go through the whole list to find, perhaps it's 1,200 stocks, to find 20, 30, 40 to make deep analysis, and hopefully 10 stocks to really watch over the next 10 years for my research platform. But let's discuss the top 10 because those I think are usually the most interesting for YouTube. Let's start, and if you get value from this, just click that like button. Thank you. So let's start with Taiwan Semiconductor Manufacturing. Recently did a video on it. Link will be in the description below. Also did a video on BABA recently and also on NIO. So all free links for deeper analysis in the description below. Taiwan Semiconductor and Korea has been a cheap market for the last years, and then simply it exploded after the crisis. You will see everything from Korea exploding, and so did Taiwan Semiconductor Manufacturing. And if we go to my template, this is the public one, so you have here the company that I analyze in public, and you can see here that dividend per share is 1.79, and they expect to grow it significantly over the next years. And then it all depends on what the terminal multiple will be, what will be the required dividend in 2030. Because if it is 2.2% 45 dividend multiple, then yes, the intrinsic value is at 124. And if I look at the stock price, we are there. But and this is also the risk when it comes to these stocks. If, I don't know, slows down or there is too much competition or technology isn't top-notch like it is now, and the market requires a 5% dividend, if I change this, then the intrinsic value for a 10% return is already half of what it is now. If they still growing, if the growth rate isn't 20% onward but just 10, then it is even lower. So for me, of course, the hottest stock in the market, a little bit too much risk now. Tencent is the second one. This is really an interesting company. I am not long the stock, but I'm long another stock that is very long, Tencent. Let's look at Tencent. Did really well over the last months, of course. The dividend yield is small, but what Tencent is a huge company, really the metaverse of China, with online gaming, with social media, with cloud, with whatever you can imagine. And if you own Tencent, you also own NIO, 15% is owned by Tencent. Meituan, the fifth largest company, is owned 20% by Tencent. I don't know, 5% of how much of Tesla is also owned by Tencent. So very, very interesting company. Let's see the quick valuation here. And I took the current cash flows, high growth rate, if they can scale on their ecosystem, terminal multiple, let's say for the cash flows, 30, and I get to 907 billion. In this case, we are talking billions. If I compare with the market capitalization, this is OTC, the market capitalization is around 800 billion, 800 something. So Tencent is a little bit, for a 10% return, overvalued, but still good with 7-8% returns. So Tencent, I think it's an okay investment. Then we have Alibaba that I did a video, I think a month ago, saying it is a buy, and earnings recently came in that are really staggering. If we look at the growth rate, 37% growth rate, and what I really look for is non-GAAP free cash flows even higher. So really, really good, really positive. And if we look at their ecosystem on the one they are scaling everything else with new seed businesses, with whatever they are doing here, and this is now a bigger pie than what it was the key pie in history. So they are continuing to grow, and they are really having more and more cash, which is key, which confirms that the business model is okay and that is making cash, which is great. And therefore, I think that Alibaba at 700 billion, 720 is relatively cheap, because if it keeps growing, then it has the potential to reach 2, 3 trillion. We've seen Apple at 2 trillion. So, okay, valuations and a lot has to happen. But from a risk-reward perspective, it's, I think, even a little bit more positive than Tencent, just as Tencent. Then you have the discounts, but that's for sophisticated investors. So nothing wrong with BABA, and always keep in mind it is risky if the growth slows down in everything, and that can always happen, but that's investing, so see how does it fit your portfolio exposure. Oh, Samsung is a big company, so, and what I have shown, what I wanted to show here is the slow growth. I have highlighted the first numbers because this is whatever the currency is in Korea. So 239, 243, 230, 235. So it's not really a growth company. It's a good company. It has been growing over the last decade, really pays a dividend yield, so price earnings ratio is normal. And as Korea was always cheap, nobody liked it because Apple will destroy it or this or that. Everybody was about to destroy Samsung. Now it finally broke out. So it was an ugly, and now it became less ugly. But this is an industrial, cyclical, slow growth company, so always want to be careful with. And they are paying their dividend, increasing slowly the cash position, so all well, all good, depending on new products. But if we categorize this, this would be a slow grower, and Peter Lynch says, really, that's the last place you want to put your money. Yes, it can jump 50%, or that could be a stalwart if it is forgotten like Samsung did, but you have to see if this fits your portfolio or not. I would categorize Samsung as good, slow, and steady. And if you want that, then it is interesting for you. Nothing wrong in a 100 portfolio, 100 position portfolio. The next one is Meituan, or however they say, the Amazon of services, 20% owned by Tencent. And this is already where we come, okay, emerging markets cheap, yes, but not that cheap. If we look at their revenue is 97 billion, this is renminbi, but if we look at their stock price, it's 2.3 trillion. So we are at 23 times sales, 23 times price to sales. Okay, this is this is Hong Kong dollars. So okay, 2 billion, 20 times price to sales, which means given the profitability, which is very low, we are about 200, 300, 500 price to earnings or price to cash flow. So really crazy priced. Everybody is exuberant. This is the Amazon of services for China. It might be, it might not be. We'll see about that, but too much risk for me in this case. JD did really well over the last year, tripled, so really good. I remember analyzing it here, and there was always one fear with JD. It seems it's subdued now, but it was about margins. Let's see what is going on. So gross margins even declined over the last years. This was why the stock was low, because this was declining and they couldn't turn a profitable margin. Now they managed to grow, good, steady growth, and they managed to turn that profit margin into a positive 2%. However, this is the key to watch also for the long term on JD. I know they are competing with Amazon, that's bigger, stronger, and they are competing with a lot of competitors there. So we have to see whether this is a long-term improvement, and this is also the reason why the stock went up, or if the margins, they can't keep their margins, then we might see 2017-18 all over again. So this is something to watch. Again, too risky, as it was the case 2-3 years ago, too risky again now for me. Reliance Industries, so if you're looking for India exposure, but look at the price earnings ratio is 30, dividend yield 0.34. Of course, they have a lot of infrastructure and growth in India. So first, they're not, not easily traded from outside India, but okay, again, let's say after this, we can say that it is already fairly priced. So again, not interested. NIO, I did a video on it with a bull thesis and a bear thesis. Feel free to enjoy that. and it really explains the stock and the risk. We don't know what will happen. I hope it will go up for all those bulls. I gain nothing if stocks crash. I just explained the risk. Pinduoduo, another stock with huge growth, but still not profitable growth. So again, a bet, but the stock price really exploded. I remember when it went public, a lot of people asked me, Sven, what do you think about Pinduoduo? But there are always risks and rewards, and given the current situation, the reward side materialized, but you never know with these stocks. Some go down, some go up, so there is always risk, and especially when the market cap is 250 billion, but the revenue is, what is this, 5-10 billion, so that's 50 times sale, extremely risky for me. So my conclusion is I would never buy the emerging market ETF because of too much risk, and everything that's most expensive reaches the top 10, and that's also what I have seen here in the top 10. I will continue from 100 and then go to value ETFs, do some summaries like this from videos. I hope I shared my opinion, which is always what you ask, so click that like button if you get some value. And really, if you want to get deeper into the market and investing and put these things into perspective, check my weighing versus voting video that I did, and that will give you a perspective on how to invest in this crazy market, because as we have seen now, even stocks in emerging markets are crazy.